Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm Justin Williams. I'm here with Matt Sands, and we are bringing you the information you need to make the most of your mineral rights and royalties. And Matt, we've got some news stories today, which these seem to be a little bit more insightful and more impactful stories than we've had in a few weeks.
Absolutely. It's definitely not been a dull news cycle, especially this month, in terms of potential issues that the industry is facing and also some more headwinds from the federal government, which is, I guess, not surprising given the stance that they've taken against fossil fuels over the past 3 years or so. But Justin, let's go ahead and dive into this first story. But before we get started, I hope that you guys noticed that little pattern interrupt we threw at you with Justin doing the intro. So we're going to mix it up a little bit in the future. I'm going to have him do the introduction and get him out there a little bit more since he's been such an integral part of the show for the past 5+ years. So with that, Justin, let's dive into the first story. We have a story about oil prices, which is always of interest to mineral and royalty owners. And the title is Oil Traders Overstretch Futures Market. And you want to dive into the high points here?
Let's do it. So traders have placed so many bullish bets that according to Reuters market analyst John Kemp, oil prices are due for a correction. Over the past 4 weeks, traders have bought a total of 183 million barrels of crude and fuel futures. The ratio of bullish to bearish bets on oil and fuels had risen almost 8-1. And oil markets may be ripe for a correction in prices. And Matt, as we're recording today on September 28th, 23, we're seeing that oil prices come up just a little bit.
Yeah, we're seeing oil prices stay steady, maybe despite the sentiment in this article. I think it's one of those things where you get towards the end of the expiry of these futures contracts is when you see the big shift as they have to roll over into the next month's contract. And I think that's when we'll see some of the disruption. Maybe it'll take a few weeks because I think we're looking at probably 3 weeks out before that changeover occurs in October. But in any case, I think it's interesting because you have pretty broad sentiment that oil prices are likely to go up. And so I think that's really interesting when you think about where we're at already, above $90 a barrel. So I think analysts are even thinking that prices could go up higher. And I think this article mentions JP Morgan saying this week that they thought oil prices could reach $150 a barrel. So I think that's a pretty interesting trend that we're looking at. And I think it really highlights the discrepancy between supply and demand, because at the end of the day, that's what really drives prices for commodities like oil and natural gas. And oil has seen a little bit of a boost in price since a few weeks ago, Saudi Arabia and Russia announced that they're going to extend 1.3 million barrel per day supply cut on behalf of OPEC Plus. And people are not as concerned about China demand for oil. That whole reopening story with the COVID lockdowns and them kind of getting back to normal, that seems to be less of a concern, that they're maybe not at the same pace that they were, and analysts were expecting them to be at as far as oil demand. But I think the rest of the world is making up for that, in terms of the demand for oil. And I think as long as you see that imbalance where there's not as much oil being brought to market as quickly, fewer wells being drilled in a rapid pace to meet demand. And as long as that stays the same, then I think we're going to see continued prices. And like Justin and I were talking before we hit record, it's hopeful that we'll see prices sort of stick around where they're at, because as we've talked about in the past, when prices go too high, it causes demand destruction, and it also has a ripple effect on terms of inflation, which is already hitting our pocketbooks. And then I think what they're really saying is, I think the long-term foundation is set for higher oil prices, but in the short term, we might see a correction in prices as traders have to roll over these contracts or settle up. And I think that's kind of the thought process there.
You said it, Matt. And, there's such an impact that the geopolitical stage can make on this, whether Russia, starts to export more oil, which has been talked about. And if there's still a constraint on supply, if their demand destruction starts happening with inflation and the economy slowing. So it'll be interesting to see where it goes. All right, Matt. So our next one here is a really interesting story. And we were talking a little bit about this before we hit record, but it's an article that was in the New York Times And the title here is Monster Fracks Are Getting Far Bigger and Far Thirstier. And Matt, the story goes on. It was a hit piece and it's an opinion piece, but I think it touches on a really interesting aspect that either isn't often talked about or a really unfair light is put on it for the oil and gas industry. And the New York Times investigation revealed that the amount of water being used has soared to record levels. Fracking wells have increased their water usage sevenfold since 2011 as operators have adopted new techniques to first drill downward and then horizontally for thousands of feet. The process extracts more fossil fuel, but requires enormous amounts of water. Together, oil and gas operators reported using about 1.5 trillion gallons of water since 2011, much of it from aquifers, the Times found. Fracking a single oil and gas well can now use as much as 40 million gallons of water or more. And Matt, these numbers just sound insane out of context. But let's put this into context for the listeners.
Yeah, and that's really why I wanted to focus on this article, because I think it's important to put some perspective to these headlines that we're seeing that are, again, I think this is totally a hit piece against extraction of oil and gas, and they're using water as the means to highlight a negative aspect of the oil and gas industry in terms of the resources that it uses to produce oil and gas. A couple of things to put into perspective. They mention a number of 1.5 trillion gallons, and that's over the last 13 years since 2011. And that roughly equates to 115.4 billion gallons of water per year, or 316 million gallons per day. And certainly that is a lot of water, but I think it is important to put it into perspective to other industries or other large users of water. And I didn't even look at the irrigation of crops for agriculture. I imagine that's even higher. Whether you think water is being put to beneficial use for each of these things, put that aside for a second. But just thinking about recreation is another big example, Justin. I like to play golf. We go out to Arizona. We have family there. We stay there, play golf in the spring and the fall. And the desert normally is dry. There's no way that you could grow grass there without irrigating it. And so that takes a lot of water. And so golf courses use an average of 2.08 billion gallons of water per day. And this is according to data from the Golf Course Data Institute. And of course, that varies on location and climate. If you're in the Pacific Northwest, they probably use a lot less water versus if you're in Arizona, they probably use a lot more. But on average across the country, if you look at that number and you multiply that out over a course of a year, that's almost 760 billion gallons of water per year. And if you look at the same time period since 2011, so for the past 13 years, that equates to 9.9 trillion gallons of water. And if we think back to that number that the New York Times mentioned of 1.5 trillion gallons of water, it just goes to show you, Justin, that we're taking it out of context. 1.5 trillion is a lot of water, seems like insane amount of water. How could the oil and gas industry be doing this? When you say, well, I like to go play golf, and I didn't realize that by playing golf and supporting the golf industry, we're using 9.9 trillion gallons of water there. And that's 6.5 times more water used in the golf industry than is used in the oil and gas industry every day. And that's, again, on average. Granted, the oil and gas industry is using more now than they were in 2011. So that number is probably, on average going up. But even still, if it was double, you're still, 3 times more, by watering the golf courses we have here in the US. So
absolutely, Matt. And, I really think you have to think, okay, we've got golf courses, we've got watering crops, we've got other major users of water. The question really becomes, how do we reuse this water? How do we recycle this water? More so than it is, how do we limit the amount of water that's being used? And maybe both are viable answers. But right now, even golf courses, they're really looking at ways on how they can try to reduce the amount of water that they're using or increase the amount of water that they're recycling. And this creates issues in the oil and gas industry because cleaning wastewater that contains those hazardous chemicals, it's costly and it's energy intensive. And Matt, that's a whole aspect which the industry is working on building. But where is it now? Where does it stand today?
Yeah, that's a good question. I think certainly the industry has goals to use more recycled water in fracking. And so that's really the source of this 1.5 trillion gallons of water. That's primarily for hydraulic fracturing and completing new horizontal wells. And the other thing that's really interesting about the oil and gas industry as compared to these other users is the oil and gas industry gets a significant amount of that water back when they produce oil and gas. So we do inject, millions of gallons of water per frac when we complete a brand new well, but the majority of that water comes back in the first several months during the flowback period and can be treated and recycled and used again for completing another well. And then over the life of the well, there's actually water that is in the pore space along with oil and gas. And so when you produce oil and gas, you produce salt water as well. And so this produced water has become a large focus on trying to treat that and then reuse it for beneficial use for completing new wells. So, use within the oil and gas industry, as well as getting it hopefully to a point where it could be used to irrigate crops, for dust control, for watering, golf courses and things like that. So I think that's a really unique aspect that isn't taken into account in a lot of these discussions, is that a majority of that water actually comes back and we can reuse it in the oil and gas industry. Whereas once you've watered that crop, you've, irrigated the golf course, then what's going to happen is to go down into the groundwater and then over time recharge an aquifer, or to, through evaporation, have it come back down as rain and refill a reservoir or something like that. But that's a very uncertain and probably a lot lower amount of reuse that occurs. Whereas oil and gas industry, we can use most of that. And it's just a matter of getting the technology and the cost down to where it becomes economic and practical to recycle the majority of the water that is produced along with oil and gas. And so when we had Jared Bays on the show in episode 187, he talked a lot about produced water opportunities. He's got a water treatment company that they're looking at. You basically deploy these units on the well pad. They can treat the water on site. Certainly there's companies, there's many different ways to do this. Companies build centralized processing facilities where they, gather all the production from the field, and then they separate the oil, the water, and the gas, and they treat the water, and then they inject high concentrated brine and through saltwater disposal wells. So they inject that really deep into these saline aquifers that would never be used for drinking water. And then they are able to use a good portion of the water that is actually produced. And so I think that is becoming a big focus. And certainly the states that are very dry and arid, like Colorado, always kind of seems to be taking the lead on these things. And Colorado recently passed regulations requiring the oil and gas industry to reuse a certain amount of that produced water. So there's some regulatory incentives, I guess you call it, for companies to start to do more of this, which is good. I think at the end of the day, we need to be mindful of the water that we're using. We need to conserve that. It's a scarce resource as well. So, certainly it's good to put the focus on this. And so to the extent that this New York Times piece does that is good, because it highlights the need to do more produced water recycling. But I think we're in a great position within the oil and gas industry because we can reuse most of that water, whereas most of these other users, it's a one and done kind of a thing. And I think it's really interesting. We did some research. According to the Groundwater Protection Council, there's a report. Justin, do you want to talk about some of the findings from that report?
Yeah. So the report talks about that a large percent of that water could be potentially treated and reused for fracking new wells, as Matt mentioned, instead of using fresh water. And according to the GWPC, the largest basin in terms of produced water production, water produced as a byproduct of that oil and gas production, was the Permian by a large margin. 2022 volumes were just over 15 million barrels of water produced per day. 2023 projected just under 20 million barrels of water per day. At 15 million barrels of water, which is the 2022 statistic for the Permian, that equals 630 million gallons per day. And that's taking the 15 million barrels and multiplying it times 42 gallons. The average use by the industry over the past 13 years was 316 million per day. So we can meet all the industry's need by recycling produced water. Granted, not all of it can be recycled. And of course, it's impractical to use produced water from the Permian to frack something in the Rockies or Appalachia. But it illustrates the point, Matt, that recycling this water can make a huge impact in this industry and for other industries as well.
Yeah, I think that's a key point. And we touched on that when I spoke with Jared. He mentioned the amount of water that was produced in some of these states like California, for example, their irrigation needs across the entire state could be met by the amount of produced water that they generate. And if it were to be treated and recycled, and we know that you can't get 100% of that water back. Some of that brine needs to be reinjected. It's too salty to actually treat it. So you can treat most of it and get the water to an acceptable water quality level for using for other purposes. But then some of it does need to be injected downhole. But even despite that, you have the ability, and the example that we gave in that particular episode was if you had a drilling spacing unit that was 2 sections of land, the amount of water that were to be produced in general, and this is a specific example in California, by the amount of water that's produced there would generate enough water to irrigate the crops over those 2 sections of land. So if you think about a beneficial use, and what a better partnership that if you were to partner with agriculture in these areas, and a lot of these oil and gas fields like, Northeast Colorado and Weld County and the DJ Basin, there's a large amount of agriculture there. And if you could partner with the farmers and ranchers and help supply water, that could be a huge benefit to them, because water rights are extremely valuable and water is very scarce. In years where there's a drought, areas like California, they're the tail end of the Colorado River Basin. And so they oftentimes run out of water and that don't have enough. So like these types of partnerships, if everything were looked at face value and on a fact base, and let's work together to produce the energy we need and to produce the water that we need to irrigate crops, there could be a huge benefit there. But I think the issue that we're seeing is highlighted by articles like this that really just are focusing on the negative aspects and the drawbacks of fossil fuel production. Whereas if we look at it holistically and look at both the benefits and the drawbacks together, the benefits far outweigh the drawbacks when you talk about providing cheap and reliable energy that the world needs, that we can do here in the United States in probably the most environmentally friendly manner in the world. That needs to be part of the conversation. So I think that's something that I just really wanted to focus on, because I think it's not helpful when you have, whether they're uninformed or I think certainly they're just trying to highlight a certain narrative that we continually see in the mainstream media around oil and gas industry bad, fossil fuel use bad, renewables good, which is really, I think, an incomplete picture of what we're really faced with. And I think we are going to really need fossil fuels for certainly our generation, our lifetimes, as well as probably our kids' lifetime. And there's really, unless we have a Manhattan Project type effort to switch to nuclear power, I just don't see that changing anytime soon. So I think that's really just an important thing to highlight.
You said it, Matt. And I think when you put this into context, it really helps to make informed decisions. And all too often we see large major outlets really take something out of context. And though they're just trying to expose and highlight something, that context is brutally important to other industries. And Matt, our next story here is more about government regulation and what the Bureau of Land Management is working on. So the title here is: a vast swath of Colorado public lands will be off limit to oil and gas leasing under the new federal plan. And it goes on to say federal land managers have proposed blocking future oil and gas development on more than 1 million acres of Colorado's western slope as they reshape how they handle energy development in the face of drying and warming in the West. This new management plan from the Bureau of Land Management covers land between the Utah border and Eagle, and it would close 1.6 million acres to potential oil and gas leasing if approved. And the plan would forestall the drilling of hundreds of future wells. And Matt, this is obviously getting a lot of noise right now, because that makes a huge change to development plans and the value of mineral rights.
Yeah, absolutely. And the thing to focus on here and to make sure that we're clear is that we're talking about federal mineral rights. And so this would be on federal lands. So they're not talking about blocking private development. But the reality of the matter, if you look at a map of this proposed area, there are certainly areas that are adjacent to fee minerals, in other words, private mineral rights, that realistically, in order for oil and gas to ever get developed, the operator would need to come in and build a federal drilling unit. And so that would incorporate both federal lands as well as private lands. And just because of the scale that they would like to have to be able to go in and drill, in enough acreage to merit building the infrastructure like pipelines and things like that. And so if you block the federal access, you're blocking access to the fee minerals in most cases in some of these areas. So I think that's the biggest concern, especially when you think about takings. And is this a violation of our constitutional rights? You don't have compensation that's given if your minerals are basically blocked from future development, then they become worthless essentially. And would there be compensation to private mineral owners if this were to occur? And I haven't seen anything mentioned about that. And I don't think that is something that's being discussed. So it's something to think about. If you do have mineral rights on the western slope of Colorado, I would strongly consider commenting on this draft management plan. We'll put a link in the show notes where you can go to the BLM website to leave a comment. And I'll look for some talking points that we could use because they want some data and some specific information in these comments, not just, hey, I oppose it just because I think it's bad. So I'll try to come up with something. So if you go to the show notes, there'll be a link there where you can go leave a comment, and I'll try to put together some talking points because it is something to think about. Because the interesting thing about this whole draft management plan is there was an environmental impact assessment, and that's where this comes from. There's a federal process called the NEPA analysis, which refers basically the environmental impact. And so there was an plan that was issued in 2016. This has been reopened, and they're looking at rolling back the amount of land that would be available for federal leasing in the future. And so that's the issue, is that they're looking at like 5 or 6 different alternatives. They have the standard plan, which is if they did nothing, which I don't expect that they would follow that. But if they did these 2, alternative E or alternative F, I believe it is, would basically take out and block a creation of 779 future wells. So that would be the most extreme side of things. So that's something to think about. And, certainly it's an area where you need to balance the conservation value and like the land. It's a beautiful area, the whole Piceance Basin. I did a bunch of work up there when I was working for Shell with the oil shale stuff, and wild horses. It's beautiful. That said, I know of other areas like Pinedale, Wyoming is a great example where there's tremendous wildlife potential and conservation potential. And there is a very coordinated and productive relationship between the BLM and oil and gas companies to come up with a plan for developing the land that takes into account wildlife migration routes, endangered species location. All of that can be managed. And instead of just a blanket, we need to shut off all of this land for conservation and never allow anything else to occur there. No oil and gas development or anything like that is short-sighted and really going too far. So I think there needs to be a balance, and certainly you need to protect wildlife, you need to protect the environment, but you can do that, still allow access to a good amount of the oil and gas resources that are there. Because Justin, I think it's really important to highlight that this area that they're talking about blocking access to in the future is part of that Piceance Basin that I mentioned, and Energy Information Administration. That basin has 5 of the top 50 natural gas fields in the United States in terms of proven reserves. And this new resource management plan and this supplemental environmental impact statement, the way they have it drafted, if they go to the alternative E or F, which is blocking most of the access, could cut off development to new shale formations like the Mancos Shale, which is something that's being explored and really has some potential there. So you talk about needing to meet our energy needs and the global energy needs. There's a highly productive area, especially natural gas, which is, lower carbon fuel. And so that's something that needs to be taken into account. And certainly if you have minerals in this area, I think it's an opportunity to speak up and let your voices be heard. So
you nailed it, man. And it'll be interesting to see what the outcome is from this. And if we do get enough voices kind of coming into this to influence it. But as you said, this stands to limit a lot of oil and gas production if they go to the extreme with it. And hopefully we won't see that extreme come to fruition. All right, Matt. So let's close this out with the rig count here. So it looks like we've lost 11 units. Is this for the last week? Isn't that?
Yeah, they do it on a weekly basis. So that's the last week's numbers. Down from 619 a week ago. And I think we were probably in the 630s, if I remember correctly, from the September news. So we're down probably another 15 to 20 rigs from when we reported on this last. So, still continuing to see a downward trend. Justin, that might pick up a little bit with oil hitting $90 a barrel. I think some of this is a matter of shifting away from natural gas basins because it's not really profitable to be drilling at less than $3 for gas. And so I think that's something that is probably being reflected in some of these numbers.
You said about, and looking at the list here, it goes on to break it down per state. I mean, I thought it was interesting, Matt, that it looks like Texas lost 5 units and all 5 of those were in the Permian. Utah lost 1, Wyoming lost 1, New Mexico lost 2, Oklahoma lost 2. And it's interesting to see that these are in some really core and proven areas. Initially we were seeing numbers a few months ago in some of the more oddball places, but now they're really focusing their resources and I guess sticking with what's productive.
Yeah, I think that's a good point. We did see the Haynesville lose 2 rigs over this period, which again, I think fits with the narrative of lower gas prices, slowing down and drilling just because it's not as profitable. But I was surprised as well to see the Permian drop off by 5 rigs. Now, some of that too, we've talked about, there's some things going on around the end of the year, capital budgets and things like that. So maybe some of that is companies are coming up against their budget for the year and they need to reduce spending through the remainder of the year. They might pick those rigs back up in 2024. Certainly if price of oil is still above $90 a barrel, we'll definitely see that. But yeah, I think it just highlights the issues, the balance of capital budgets, the measured pace of the industry. So despite oil prices hitting $90 a barrel, operators are not quickly responding to that because they don't want to oversupply the markets. They've learned the lesson. They're only reinvesting cash flow. So that puts a limit on how fast they can drill these wells and how many wells they can drill per year. Despite higher oil prices, we're still seeing maybe a little bit slower drilling activity, which is good, I think, because it highlights the capital discipline that the companies are showing, and it hopefully will result in continued financial strength. Because I know the last 3 quarters have been lower earnings reported. And, again, that's due to lower oil and gas prices as compared to 2022. So be interesting to see how this shakes out. We're not seeing a huge drop, which is good. I think that's maybe the silver lining out of this. Hopefully we'll see it sort of stabilize and then and not drop anymore here in the next couple of months as we end 2023. And then again, I think if oil and gas prices are staying where they're at, we're going to see that pick up again next year potentially.
Well, Matt, that does it for the October 2023 news. Some interesting stories.
Interesting stories for sure. So thanks again for listening. Again, you can find links to all the articles we talked about today, as well as some additional resources in the show notes, which can be found at mineralrightspodcast.com. And if you find an article you'd like us to cover in a future episode, just send us an email to feedback@mineralrightspodcast.com. Until next time. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.